There's a different tone in the market right now. People are no longer asking, how high can this go? They're asking, how bad could this get? Economic data feels fragile. Volatility comes back quickly. Headlines swing between hope and warning. And when emotions rise, decision-making usually weakens. So today, I want to talk about something very important. How can we stay invested in long-term innovation without taking unnecessary risk? And for me, one of the most powerful tools in uncertain markets is deep in the money leaps. This is not about predicting the next rally. This is about structuring exposure intelligently. 1. The mindset shift. Every market cycle requires a different mindset. When markets are strong and trending up, aggressive positioning often works. Momentum feels safe. Risk feels rewarded. But when macro uncertainty rises, preservation becomes just as important as participation. The goal is no longer to win quickly. The goal is to survive intelligently so that you can still participate in the next major move. And that's where deep in the money leaps come in. 2. What are deep in the money leaps? Let's simplify this. Leaps are long-term options, usually 1 to 2 years out. Deep in the money means the option already has intrinsic value. It behaves more like stock than like speculation. Instead of buying full shares during a volatile period, I can buy a deep in the money leap that has high delta, moves closely with the stock, has most of its value coming from intrinsic value, and gives me time for my thesis to play out. In simple terms, it acts more like stock replacement than a gamble. That difference matters. 3. Why this matters in a recession environment. In uncertain markets, capital efficiency becomes very important. Let's say instead of putting $50,000 into shares of a strong company, I might be able to get similar directional exposure using $15,000 to $20,000 in deep in the money leaps. Does that remove risk? No, but it changes the structure. My maximum loss is defined by the premium I paid. I maintain long-term upside exposure, and I keep cash available for opportunities. In volatile markets, liquidity is power. Cash gives flexibility. Leaps give exposure. Together, they create balance. 4. Intrinsic value versus hope. Here's something very important. In high-fear environments, implied volatility rises. Options get expensive. Many traders chase out of the money calls because they look cheap per contract. But most of that price is extrinsic value. It's based on hope and probability. If the stock doesn't move quickly, time decay and volatility shifts can hurt you fast. Deep in the money, leaps are different. You're paying mostly for intrinsic value, real position, not just possibility. That reduces emotional pressure. You don't need a fast move. You need a sustained trend. That's a big psychological difference. 5. The checklist. This strategy only works with discipline. Before I enter a deep in the money leap, especially in a recession-sensitive environment, I go through a checklist. First, I look at the company. Does it have a strong balance sheet? Manageable debt? Consistent free cash flow? Second, I look at structural growth. Is it aligned with long-term themes like artificial intelligence, cloud infrastructure, enterprise software, digital transformation? Third, I look at technical positioning. Is the stock near support? Is it extended? Am I chasing? And finally, I structure the option carefully. I focus on high delta, majority intrinsic value, 12 to 24 months until expiration. This process turns fear into structure. 6. What this strategy is not. Let's be very clear. There is no such thing as recession-proof. Deep in the money leaps can still decline if the stock falls significantly. This strategy does not eliminate risk. It reduces fragility. It avoids excessive leverage, short-dated pressure, emotional overtrading. It replaces urgency with structure. 7. The psychological shift. For me, the biggest shift has been psychological. There is a huge difference between, I hope this works next week, and I am positioning for the next multi-year cycle with defined risk. Deep in the money leaps, allow me to stay aligned with innovation while respecting macro uncertainty. Volatility does not require panic. It requires evolution. Markets will always move in cycles, expansion and contraction. Big money is still made in big moments. But you only capture those moments if you are structured well enough to endure the uncomfortable ones. This is not financial advice. This is simply the framework I use to navigate uncertainty calmly and strategically. Stay patient, stay structured, and stay long-term focused. I'll see you in the next video.